As Jocelyn's just stated, this is a session for IFRS 16. Over the past couple of years, obviously IFRS 16 has been a large deal for the accounting industry at large, but particularly for airlines as well. Obviously, we could cover a lot in this presentation in terms of the scope of IFRS 16, but we've just chosen to pick out some key areas of perhaps divergence that we've seen within the working group. As Cathay Pacific, obviously, we have a particular view on some of these applications, and Thomas Egan, who's also on the call as the accounting expert for IAWG and for IATA, will also help explain some of the other approaches. So I'll run through the slides and ask Thomas to also add some aspects as we progress through. So if we turn to the objectives, there's four key areas that we see. Jocelyn, I'm just waiting for you. That's right. One more slide, Jocelyn. Right, super. So we've got four key areas that we want to cover on IFRS 16. Really, the first one being the major one, which is how to account for maintenance on leases. And then we've got three other areas which we will also cover around auto renewal of leases, interaction of lease terms and useful life, and also the treatment of value-added tax where it's unrecoverable or irrecoverable. So turning to the first one, which is major maintenance on leased aircraft. I'm just waiting for the next slide. One more slide, there we go. Okay, so under this, there's been a number of approaches that seem to have emerged as the standard has been studied and adapted to the airline industry. We're going to look at three of the most popular of those that seem to have transpired and that we've become aware of as part of the IATA working group. Important to note that at this point in time, all three of these approaches have been accepted by auditors, and they all broadly have a similar profit and loss outcome, but there are differences from an asset and liabilities perspective. Even though we say a similar profit and loss outcome, there is, however, a variance in the way that EBITDA is then reported, because as you'll see just now, with the three approaches, there is either an expense that comes through the P&L, or a depreciation that comes through the P&L, or a hybrid of the two. So depending on which version you're using or which option you're taking, it can have impacts for EBITDA. A lot of the problem really transpires from the fact that the IFRS 16 requires depreciation to follow IAS 16, but what it's not addressing as part of the standard is whether the lease of an aircraft is what is covered, or whether it's the lease of an aircraft and the aircraft potentials that are covered. And just to explain what we mean by the word potentials, in this case, potentials are those usage-based, or the usage-based element of the underlying asset. So that's the major maintenance elements, whether that's your engine restorations, your D checks, landing gear, etc. So potentials are the usage-based element of the arrangement. So turning to the first of the approaches that is transpiring, the first one is called what we're deeming as the provisions approach. We can just turn to the next slide. Okay, back one, there we go. So under the provisions slide, or the provisions approach, this is effectively an all expense related approach from the point of view of the potentials. So in this case, the right of use asset is treated as a single component. There's no separate componentization within that. The decommissioning costs are added to that ROU asset. However, in terms of major maintenance, a provision is effectively established and built up as the potentials are utilized or used over the course of the lease, and they're reversed either when there's a maintenance event and utilised against that maintenance event, or it's utilised as part of the aircraft return conditions that have to be met. So in this example, effectively all major maintenance is treated as a maintenance expense rather than as depreciation or a part of depreciation and a finance charge. And this is really consistent with how many airlines have applied IAS 17 in the past for leased aircraft, i.e. forming a separate provision. So that's one approach. I think the argument for this approach is that the payment to the lessor is a payment for the use of the aircraft, and that forms the right of use asset. But the return of potentials is really a separate obligation, and that obligation, in accordance with IAS 37, is then provided for as that obligation arises. So as you use the potentials, use the usage-based part of the asset, a separate obligation is created. I think that this argument or this approach is kind of valid, especially where you've got a full life return condition for an aircraft. However, I slightly struggle from a Cathay Pacific perspective. We slightly struggle with this when you've got a half-life or a nil life return condition, as effectively you've got either a reduced or a nil potentials obligation to give back to the lessor at the end of the lease term. And if you've got a reduced or nil obligation, and effectively creating a provision for major maintenance, even if that's going to happen during the course of the term of the lease, there is no real obligation there to an external party. That's an internal arrangement. So it works for full life return conditions, but for half life and nil life, there's a potential. I'd see a potential disparity in this one in terms of that of the conditions of IAS 37. The second approach that is arising is what we have called the components approach. So unlike the first, the provision approach, which was all potentials become an expense, a maintenance expense effectively, under the components approach, all the potentials become a depreciation. So in this approach, the ROU is created as a single component from the minimum lease payments together with the decommissioning costs. However, what happens then is that you create a separate asset on day one for the engine overhaul and D-checks, or the potentials, as effectively we're saying that they're either bought or borrowed from the lessor, incremental to the lease, i.e. on day one, the aircraft has a full set of potentials, and there's an obligation to return those potentials under a full life return condition this assumes, and therefore you create on day one a separate asset for those potentials, and the double entry for that is that you create a provision for major maintenance also in full on day one. That major maintenance provision is then only reversed at the return of the aircraft. It's either released against the potentials or the cash on at the end and reversed out at that point in time. So effectively, in this way, all the major maintenance is created as an asset and on day one and treated as depreciation. So I think in this case, any major maintenance event that occurs within the lease period would then be also capitalized again. So effectively, as per bullet point 3 there, we create an asset on day one that is amortized or depreciated to the next maintenance event, and then a maintenance event occurs, and it's capitalized again effectively as a component, and that is also then depreciated over its useful economic life. That means, as per point 4, that at the end of the lease term, when you're returning the aircraft, effectively you have a full provision for that major maintenance at the return, and that can either be returned in cash or part of that provision used to write off any residual net book value that's remaining at the end of the lease term from the second capitalization or the maintenance event that happened during the life of the lease. So effectively, in this case, there's an asset being created, but for the potentials, but it's not actually being created from lease payments itself. It's being created on day one as effectively for a compensation and establishing a compensation provision that will be utilised at the end of the lease. I think from a CAFE perspective, I have an issue on this, is that on day one, you effectively create a liability which doesn't really yet exist because you haven't used any of the potentials of the aircraft. And in my view, and this is different to other airlines, in my view, then you have almost an incorrect gross up of both the asset and a liability. So the net effect on the balance sheet is nil, but you have a gross up and create this provision on day one for something you haven't actually utilized yet. But there isn't. I can see merit in why this approach has arisen. As I said, this approach is all depreciation for the potentials. The third approach, which we are calling the IAS 16 approach, which I guess ostensibly is a somewhat of a hybrid between those two, where you end up with the potentials being partly depreciation and partly an expense. In this case, the ROU asset is treated much like an owned asset from day one, and instead of being a single component, the ROU is broken up in day one to separate elements, being the underlying airframe and then the potentials of the engine overhaul, D-checks, landing gear, etc. Those components are then depreciated over the useful economic life, and to the extent that those will be within the lease term, you then have a separate capitalization when that next event or maintenance event happens. Again, the decommissioning costs are included in the ROU asset in this case. And from day one, a provision is started to be accrued from day one. It's not made fully on day one, unlike the components approach, but more akin to the provisioning approach. The provision is made from day one for the return conditions that are expected to be transferred or paid in cash, and that's accrued over the life of the lease. That provision, depending on the approach you take for your component depreciation, can either be just for the cash repayment element at the end of the lease, and that would be the case if your component depreciation is matched to the underlying lease term, or that provision could be for not only the cash piece but also for writing off any residual net book value of the components if you're treating the components as a useful economic life which goes beyond that of the lease term. So it could be two approaches to how that provision is made. Point four there is, as I said, is the any actual maintenance events that happen during the lease then are capitalized and depreciated. And this means that most major maintenance is recorded as depreciation, but there is also a provision that goes through as an expense for the return condition specifically. And this is the approach that certainly Cathay Pacific is taking. So in each of those three cases, a different outcome would transpire in terms of whether you have an expense, a maintenance expense, or a depreciation going through the P&L, and that would impact your EBITDA. And as we've seen already, that some of those would end up in a grossing up of the balance sheet, or a different composition of the balance sheet in terms of the way they're applied. So three different approaches, all with similar P&L outcomes at the end of the day. I'll just stop and pause there for Thomas maybe to add anything that he thinks I may have missed before we move on to the poll questions and to see how you're treating those in your different businesses.
Okay, Sean, no, I think you did an excellent job of covering over those points. The only thing I would add is that in the working group and also in discussing this with the accounting firms, the comfort level on this is that it gives a very consistent P&L outcome. And I think that's why these, this variance in approaches, and there actually, as I understand it, at least a dozen different approaches out there, being oftentimes variants of these approaches. So I think that we're supportive of these. They all can make sense, but at the same time, I think, as you pointed out, you have to be careful about what are the actual return conditions and making sure that whatever approach you take reflects the contractual arrangement. So that's all I would add.
Okay, excellent. So we'll move now to a poll question to see how the attendees on this webcast are going to be approaching the application.
Just give us a second. So we have a poll question here, and we're giving you 15 seconds to answer. The question is that clearly there's a diversity in approaches. Which method will you apply in respect to major maintenance? First, provisions approach. Second, components approach. Third, IAS 16 approach. And fourth, another or hybrid approach. If you can please participate, and we're giving you another 15 seconds, please. We're still waiting for a few people to join the poll. Okay, we're closing the poll now. And Sean?
Very good. So I believe, can everybody else see the results of the poll as well, Jocelyn?
Yes, everybody can see the results.
Okay, great. So that's quite interesting that 67% are applying the IAS 16 approach. But it does show, as we suspected, that there is diversity in the application. That's only not 100% in one category. So interesting. Tom, anything else to add to that?
Not surprised by that. I think that the components approach was something created by a single airline that got some following, and the provisions approach, I think, is something that just carries the legacy forward of IAS 17. And I think the IAS 16 approach is the one that's being more supported by the accounting firms.
Okay, I'm just looking at the question list, and I can see there's one question that's come in. So the question is, can the components approach be used in the case of shortfall on major maintenance cost for which maintenance reserves have been paid to the lessor? But I think my view would be that maintenance reserves and IFRS 16 accounting are two different things. I see maintenance reserves purely as a cash protection accounting, which is effectively underwriting that a lessee will perform a maintenance event, rather than anything to do with the right of use asset accounting and the associated liability. So maintenance reserves are purely credit cash and debit. So I'm just looking. That's right. Maintenance reserves. I think that's purely you're keeping a reserve. You're paying. Sorry, it's a reserve to the lessor. So it's purely a balance sheet. It's purely a balance sheet entry from a cash perspective. It's unrelated to IFRS 16 accounting. So whatever approach you adopt under IFRS 16, I don't think it would impact your maintenance reserves. Maintenance provisions clearly very different to maintenance reserves. again, Tom, anything you would like to add to that?
Yeah, I would agree with this. What I would say, though, is that I've been having some discussions with some airlines where the concept of maintenance reserves is a bit of a broad one, and sometimes it's referred to as supplemental rent, and that's for bankruptcy reasons. And in other cases, the maintenance reserve effectively becomes property of the lessor. So I think you have to, again, look at the contractual terms to understand what is the purpose of that reserve. If it's for reimbursement, I completely agree that this has nothing to do with the maintenance accounting. It's set up there for protection of a credit protection mechanism, and so but I'm finding that the agreements are very different.
Okay. No other questions I can see on there at the moment. Is that correct, Jocelyn? Is that just the only question we've got?
That's correct. So we can hide the result of the poll and we continue with the presentation.
Okay, we'll move on to the second topic, which is auto renewal of leases. So auto renewal of leases, I think on this, some leases provide for a lease to continue on existing terms until there's either party gives a notice to cancel. That's kind of one outcome. Or another way is that a lease term, there is a lease term, but there's a right for either party to cancel that lease prior to that return. So two potential ones. IFRS 16 kind of addresses the second one of those and requires an assessment of whether there's a significant penalty exists, and if none exists, it states that the contract is not enforceable and is therefore not a lease. If it is enforceable, and the question remains what is enforceable, then the option is assessed for reasonable certainty. So as the last bit there, the question remains whether a right to cancel relates to an auto renewal lease or not. Really depends on what's enforceable. We turn to the next slide. So the question is, what is enforceable? So one view is the view I've just said in the previous slide, is that we've got a contract that is on a perpetual contract, and that may be cancelled by either party. If that's the case, then it should be assessed, one, for any significant penalties, and if those are present, number two, whether there's reasonable certainty in relation to the option to cancel. So the option to cancel, there's a reasonable certainty around that. An alternative view is that the contract is only enforceable for any notice period itself. So if there is an option to cancel, or it can be cancelled by the party, but there's a notice period within that, then there's only an enforceable period to that extent, and effectively no option to cancel exists unless the period to be cancelled is enforceable. This does kind of lead to some different outcomes, and as IATA and the working group, we kind of we've discussed and favour the view that a contract is only enforceable for the notice period. So kind of the second of those two views. I think this. I don't think we've seen too many incidences of this, but unusually this may happen, or slightly more usually, shall I say, this may happen when a lease has actually expired and a new one has not yet been entered into, and I'm sure many of us have come across those scenarios, and therefore you're left kind of guessing what the lease term may be, and so whether you need to reference back to the original lease as to what the conditions were, and that infers what the likely new term would be. There's also been a bit of a complication in that IFRIC has changed its view in their commentary from reasonably certain to probable. I think this is an area which has got some divergence in terms of the way it's treated. And I guess we've got a poll question here to say, if we can just go to your next slide. We've got a poll question here to say for perpetual leases, if you have any, or even if you don't, would you apply a term equal to either just the notice period that's within a perpetual lease, or would you apply the reasonably certain option period, or that's the option where the option is one of cancellation? Which one would you apply? And it'd just be interesting to see what the participants on this webinar are thinking in that case. Again, Tom, whilst people think through that, anything else you'd like to add to that?
No, I think that you've explained it very well. I would emphasize that this issue generally there's a difference in terms of outcomes when you get to the point where the lease is near expiration and you are intending to enter into another agreement but haven't done so, or where you're basically extending the lease without any contractual rights being created. Then you can get different outcomes. Generally, the outcomes should be the same applying either approach if you have a contract in place.
Show the result.
Okay, so the poll results are up. The reasonably certain kind of option period seems to be the more favoured one, and I think certainly that would be what we would apply within Cathay as well. But interestingly, as a working group, I think the view had come out as the notice period potentially is the more legally true form of it. But an interesting diversity there as well. Okay, if we move on to the next part, number 3, or the third area we wanted to cover, which was the interaction of. I seem to have lost the. I'll just wait for Jocelyn to put that back. So number 3, which is interaction of our lease terms and the useful life of improvements. So 2 views have emerged on whether the useful life should be limited to the lease term, or whether the so one view is that we see the lease term as the limit, as that is the period for where the lessee is reasonably certain of holding the asset. So that's one view. The other view is that that's just a factor. The lease term is just a factor to be considered, but it's not a limiting factor, as the useful life is based on what is probable under IAS 16 and not reasonably certain as defined under IFRS 16. It really depends on your view as to the difference between what probable means and what reasonably certain means. And I think that in itself has led to some diversity in application. There was an agenda decision. I think just turning to the next page, we've got an agenda decision, the IASB and IFRIC, that down towards the bottom of that agenda decision, it states that the committee observed that by applying the relevant paragraphs of IAS 16, an entity might often reach a conclusion for leasehold improvements that the entity will use and benefit from the asset only for as long as the underlying lease term. So that's might often reach that conclusion. In terms of an airline, in the airline world, and a couple of airline examples, just moving to the next slide. Sorry, Justin, have you got the next slide? Yeah. So a couple of areas that to think about. An airline may determine that the exercise of an option over an aircraft is not reasonably certain, but still conclude that it's probable under IAS 16, and therefore the useful life of an improvement could exceed the lease term. That's one example. We've discussed. Another example is an airline may make significant leasehold improvements to a leasehold property, especially guess in our cases for something like airline lounges, where no enforceable right exists to extend a lease and have a useful life beyond the remaining lease term, but it's probable that we would retain the use of the asset by entering into a subsequent lease. So certainly from a Cathay Pacific perspective, we've taken that decision that where we've invested certainly in a lounge renovation, for example, that the short-term nature of the leases would continue to be renewed in subsequent leases beyond that term to support the investment in the underlying asset or the leasehold improvements. Again, it'll be interesting to see whether you've had discussions with your auditors and where you've come out with your decisions on that. So again, just a quick poll question to see whether you would only match to the lease term, where that is less than the useful economic life of a leasehold improvement, or whether you would match the useful economic life of the improvement, irrespective of the host lease term. Again, whilst you're thinking about that, Tom, anything else you'd like to add to that one?
Yeah, I think one of the things about this issue is that when this went to the IFRIC, to the Interpretation Committee of the ISB, the staff person wrote a paper which had a very different language from the final agenda decision, where she indicated that it would be essentially rare that these would not be the same. Now, that language didn't carry over into the agenda decision and subsequently was challenged and resulted in the soft language that now is in the agenda decision. The problem oftentimes, though, is that people around that table, being the accounting firms, have read these papers and they get an idea in their mind, and they tend to see this information as relevant. So you might have challenges from your auditors based upon those discussions if we've had. But what they need to do is apply what's in the agenda decision, not what's in the staff paper.
Okay, so we've got the results of the poll up, and interestingly, matching to the underlying lease term as the limiting factor is 62%, rather than matching to the useful economic life. I think it slightly, perhaps an interesting outcome from my perspective. I would have thought it would be probably in favour of the useful economic life, but I think it would be circumstance specific as to that assessment. Okay, moving to the last part, which is just a very brief one to talk about the treatment of VAT and lease agreements. Luckily, this is not one that I've had to deal with and think about too much from a Cathay Pacific perspective. In Hong Kong, we don't have VAT, but I know this is a problem for many other airlines that do have VAT, and it's deemed to be irrecoverable in respect of the airline industry as an exempt or irrecoverable input tax. So under obviously VAT is usually paid by lessees where VAT is applicable. Effectively, this is not this cost is not made to or not paid to the lessor for the use of the underlying asset. It's really complying with legislation, and therefore they don't form part of the liability or the right of use asset. However, under IAS 16, it requires unrecoverable VAT to be recorded as part of the cost of an asset. So if you suffer the input VAT for the acquisition of a normal asset under IAS 16, you would capitalize that. But it doesn't apply in the case of a right of use asset, as this is measured under IFRS 16. VAT on initial direct costs. So I think IFRS 16 does talk to initial direct costs being captured under the assessment of an ROU asset. But I think we've considered the view that VAT on lease payments is not an initial direct cost, or there may be, very initially there may be an element, but the ongoing lease payments, the VAT element is not an initial direct cost of obtaining the lease. So what this kind of leads to as an outcome is a difference between the application of IFRS 16 and IFRS 16, where one capitalizes unrecoverable VAT and the other one does not. I guess there's been a degree of debate around that. We don't have a poll on that per se, but I think that was just an interesting point that has led to a discrepancy between the two standards. Again, Tom, anything else you'd like to add to that?
Yeah, I would say that one of the considerations I have on this is that when you go to actually account for the VAT, whether you capitalize it or not, the unrecoverable VAT, you would get this the same recognition pattern, although in a different, it would be an expense rather than a depreciation expense. And so similarly with whether or not this VAT is picked up as part of your right of use asset, or if this is not, you're going to get a similar P&L outcome, but of course it's going to come down to whether or not it's depreciation or another type of expense. So the issue becomes one of EBITDA, not of P&L. The other aspect someone in our working group raised was, well, previously this VAT was treated as part of the rental expense on aircraft, but now what do I do with it now? Because if it's not part of the right of use assets depreciation, what do I call this? And I guess it becomes an other cost. It's not an income tax. It's a type of tax, definitely not an income tax. So you're going to have to decide what you're going to categorize this. I mean, in IATA we have a category of taxes, so we show this under that list of non-income taxes. You're going to have to figure out a proper place to put this.
Agreed. Yeah, agreed. Okay. So those kind of cover our four kind of key areas that we've been discussing and seeing for IFRS 16. I think it's kind of over to you all now to see if there's any other questions you would like answered against those particular areas. I see on the question box there's not anything else that's been added yet.
Good. While we're waiting for the question, Sean, I think it would be good for Tom to actually go back to the initial slide and maybe give a bit of a background regarding the working group. Because one of the key initiatives of the working group and the Industry Financial Advisory Council is this webcast. We are trying to reach out to as many people to the financial community to bring the initiatives not only of IATA but of the whole industry back to the airlines themselves. So one of the initiatives is this webcast. This is not usually have a very high popularity. That's why we're trying to reach out as much as we can so that we can educate people as much as we can as well. And so maybe Tom, you can educate us a bit more about this working group.
Okay. Yes, the Industry Accounting Working Group is one of 8 working groups under what's called the FINAC, the Financial Advisory Council. We have 15 members and generally three observers. But what we do also is we invite the 4 accounting firms to join our meetings, and generally we have 6 to 8 persons from those accounting firms, generally senior aviation partners. So that's been very helpful. Now our working group cuts across geographies, but it also cuts across the size of airlines. So we have obviously large international carriers represented, but also smaller airlines. and we even have one cargo airline. So we do recognize the industry is a bit broader than any one place or any one type of operation. So we meet 2 times a year, and what we do, our output is in many ways the thought leadership that comes out of those meetings, and then we engage stakeholders inside and outside of the industry in order to advocate the agency's views, or the airline's views. The other thing that we output is we produce guidance and disclosure guides. So if you go to the IATA website and you look for IAWG, you will find that we have issued extensive guidance in relation to this standard, as well as IFRS 9 and 15. Also, you'll find 4 disclosure guides that we published in cooperation, that we co-branded with KPMG. Now we're in the process of revising some of those guides and issuing fresh ones on this standard which will be coming next year, and then IFRS 9 and 15, which will also be output next year. So those, we're hoping that we actually get co-branding with all 4 of the accounting firms this time. So that's the primary purpose of our working group. Now, what we do encourage is that all airlines input into this working group, and you can do that in one way by attending this webinar. In a second way, you can do that by attending the World Financial Symposium, which this coming year will be in Dubai at the end of September, in which we have a track at that symposium, and it's an opportunity to meet a number of us and to engage with the working group. And we'll of course meet at the WFS. Our working group meeting is the first 2 days prior to WFS, and so this is another opportunity if you're coming to engage people from the working group. Also, there's a limited number of opportunities to attend our meetings as a guest. Again, very limited, and we have to be very particular about who we allow, and you would have to get the support of your CFO in order to attend that meeting, and there would have to be a stated purpose to your attendance, but that's another possibility. And then finally, I'm always available. If you have issues you want to bring forward, you can bring them to me, and I can address them through the working group, or I can address them directly if it's something we've already discussed, because your input, it's very valuable to us in understanding what goes on outside of our limited number of members. And so a lot of really good issues have been brought through that type of channel, so we would encourage you to do that. And then one last thing, we also, on this standard, we're actually doing courses. And so these courses are on the IATA training website, and for next year we have scheduled the IFRS 16 course in Singapore from the 11th to 12th of May, in Geneva from the 31st of August to the 1st of September, and in Beijing from the 21st to the 22nd of September.
Sorry for that.
Okay.
Okay, actually, thank you, Tom, for mentioning that. Aside from what Tom has mentioned, there's actually, as he has mentioned, there's a particular course is going to happen starting next year about this particular topic, but also there's an IATA Airline Financial Professionals community on LinkedIn, so that you can actually interact with like-minded people and also learn how the industry is growing, and from your colleagues from the different airlines and the industry itself. I will send you the link so that you can join this LinkedIn community, and it's welcome to anybody from the airline industry. And also, I would like to also highlight is that one of the working groups in the FINAC is the HIPO, and what they have proposed and actually developed and implemented is the IATA Finance Academy. The IATA Finance Academy offers new courses on the latest trends in aviation finance and today's management tools to develop airline finance professionals into business partners and value managers. I will also provide you with a link of the different courses that's currently available for you. And these are the courses that might be relevant for you and your colleagues in your department. And as Tom mentioned, the accounting for leases in aviation industry, these are the particular dates and the location coming in for next year. I also mentioned earlier today is that there are several webcasts or trainings that are going to be provided for finance professionals of our industry. Because you have subscribed to this webcast, you'll be automatically invited to the next one. If the topic doesn't concern you, for example, the next topic in January is about transparency in payment, please forward it to any of your colleagues that might be touched by this particular topic. This way is that we can be able to actually reach out to more people in the airline industry to be able to share the information as much as we can. So I don't see anybody typing any question. And again, even after this session, and you have any particular question that you would like to address, you have my email address from the reminder for the webcast that you have been receiving. And also I'll be providing the email address of Thomas Egan. He is the technical expert for this working group. And feel free to reach out to him for any question that you might have even after this webcast. Please expect all the supporting documents latest by Friday from this webcast. And there's another webcast this afternoon, Geneva time. And I will also provide to you any questions that might be arising from that particular session. So if there's no question, thank you so much for your time. And thank you so much, Sean and Thomas, for joining us for this morning session.
Thank you.
Great. Thank you.
And have a good day to everybody.